Greetings everyone, and welcome to SHF Money. This past week marked a significant moment for gold and silver. Both metals not only confirmed weekly closes, surpassing the double top highs seen in late December, levels that many technical analysts on platforms like YouTube and X predicted would cap the bull run, but they shattered those thresholds entirely. By doing so, they achieved new highs, supported by strong technical and fundamental momentum. This development also validated the analysis exercise we conducted last week, demonstrating that the supposed double tops were merely a brief pause before the next upward surge. What's particularly remarkable about this rally is the sheer strength of the momentum. Despite silver relinquishing some of its gains toward the close of the week, it still managed to climb over $10 per ounce within just 1 week. Such a dramatic increase has only occurred twice since 1971, with silver gaining nearly 200% in the last year and tripling in price over the past 12 months. Gold has similarly surged, up by an impressive 71% during the same time frame, seemingly preparing to hit $5,000 an ounce. Meanwhile, the S&P 500, despite being a headline grabber in recent years, is lagging behind with a modest annual gain of just 20%. This all unfolds as gold and silver solidify their positions as the two largest assets by market capitalization, excluding bonds and real estate, in line with my previous forecasts for 2024 and 2025, when I anticipated they would secure the top two rankings. These developments stand out even amidst all-time highs in the S&P 500 and an ongoing speculative boom in tech and AI. As gold and silver prepare for another breakout to even greater heights, it's essential to understand how this surge has occurred and how it will continue. In this video, I'll examine what triggered the exceptional movements in gold and silver in 2011 and why we haven't yet seen such patterns replicated by 2026. I'll also leverage my foreign currency benchmarking methodology to forecast potential price trajectories, comparing them with cycle top levels highlighted in 2024 and 2025. This predictive insight will help set realistic expectations as we look ahead. Lastly, I'll address an important and urgent matter: how current trends in the metals market may lead to critical actions from not only major banks, but also national governments. I will provide guidance on what lies ahead and how these developments will influence the value of your gold and silver holdings. Make sure to stick around until the end, as there's crucial information you don't want to miss. Before diving in further, please take a moment to visit Summit Metals, com for competitive pricing on gold American Eagles and other premium gold products sourced globally. It's worth considering a purchase before gold potentially hits $5,000 an ounce. As an added bonus, new customers can receive 5 ounces of silver at spot pricing. Details are available through the link in the video description below. If you're looking to sell, although I'm personally not selling now, they are currently offering fair prices close to spot value for gold and silver. Now let's get into it. In our discussion last week, I explained why the December highs of 2025 didn't signify a peak in the metals market. My analysis relied on data-driven indexing to highlight key differences between those figures and the historic peaks of 1980 and 2011, leaving no room for conjecture. Concerns over adjustments to the Bloomberg Commodity Index, propagated mainly by mainstream financial channels and their big bank backers, were distractions aimed at deterring investors from holding physical gold and silver. It is also worth addressing comparisons some have drawn between these recent moves in gold and silver with the 2011 blow-off top. What must be understood about 2011 is that such a peak was driven largely by widespread panic. After emerging from a global financial crisis, high debt levels across Europe in 2009 triggered fresh turmoil within international bond markets. Importantly, unlike back then, we have yet to witness such a panic today. But let me be clear, this moment of financial turbulence is inevitable. When it arrives, it will far exceed the events of 2009-2011 in severity. The reason is simple. During the economic chaos of 2008, global coordination efforts were key to stabilizing markets, with countries such as China purchasing vast amounts of U.S. debt to prop up the system. That level of international cooperation is now history. Currently, China is offloading U.S. debt rather than acquiring it. This erosion of global cohesion means that any gaps within today, as Western financial systems, will likely be patched solely by freshly printed money or digital dollars created by the Federal Reserve, which we know has already started expanding in December 2025. Added to this is an even more polarized geopolitical climate compared to 2011. The dangers of geopolitical conflict remain high amidst an ongoing scramble for resources, a trend aggravated by escalating global economic uncertainty. Economic tensions are all things investors struggle with. In summary, as we witnessed in 2025, rising demand has significantly driven metal prices upward, with 2026 demonstrating even stronger momentum. This trend isn't showing signs of slowing down. A key factor highlighting this rise is the behavior of U.S. interest rates, which, unlike historical peaks in gold and silver prices in 1980 and 2011, are still on a downward trajectory. Gold and silver price cycles typically peak only after interest rates hit their lowest levels, with market analysts forecasting 3 to 4 additional rate cuts in the U.S. during 2026. It's clear that gold and silver have not yet reached their high points. This scenario contrasts starkly with 2011. Previously, I had suggested the current trajectory for these metals resembled their positions between 2003 and 2006. However, given recent surges in value, it now seems we are closer to a stage akin to 2006-2007, nearing the culmination of their first significant growth phase. Yet, the most dramatic movements for gold and silver, if measured in US dollar terms, are still ahead. The impending downward movement of the US dollar, influenced by inflationary pressures stemming from Federal Reserve policies, such as increased money printing, geopolitical uncertainty driving further diversification rather than consolidation, and the assured continuation of interest rate cuts, will further propel gold and silver prices upward. Historical parallels can be drawn from other Western-aligned nations such as Australia, Canada, and Japan. In these countries, gold prices have outpaced those in the US dollar significantly since their prior peaks in 2011, growing by 258% versus a more modest rise of 152% when measured in dollars. Similarly, silver in these regions has achieved increases between 177% and 266%, far surpassing an 88% rise in US dollar terms. As the US begins to align more closely with these international trends, gold and silver prices still have significant potential to catch up. Projections anticipate gold reaching $7,500 per ounce, and silver surpassing $150 an ounce within the near term, possibly even this year, though rapid fluctuations can be expected on the way to those targets. Looking further ahead to longer-term predictions shared in 2024, gold may reach $11,800 per ounce and silver $250 per ounce before taking a pause for price consolidation. For current investors in precious metals, this is a time to remain steadfast. For those considering investing now but feeling apprehensive about recent fluctuations, it's worth starting with a scheduled approach to buying since there remains substantial growth potential for these metals. Conversely, cash-based currencies such as dollars, euros, yen, and others face limitless downside risks as their purchasing power continues to erode. Before discussing purchase control's implications for the metals market, consider alternative strategies for asset diversification. If you've recently sold gold or silver to lock in gains or reduce exposure, think about reinvesting some of that cash into tangible assets like land. Platforms like Land of Land offer cost-effective opportunities, with options starting at $1,000 across both rural and developed areas. They facilitate quick transactions with credit card payments available and ensure prompt delivery of title deeds. By using SHF Money as a promo code when purchasing land through their platform, buyers receive $300 off, making it an attractive way to convert liquid assets into something enduring that central banks cannot replicate. Lastly, a question from Aaron Fulps adds another layer to this discussion. What happens if major banks betting against silver, currently facing substantial losses, receive government bailouts? Reflecting on lessons from the global financial crisis offers critical insight here. The Federal Reserve and governments worldwide have consistently demonstrated a readiness to rescue large financial institutions when they face collapse. We will now delve deeper into this topic to address Aaron S.'s inquiry while shedding light on why the current environment is pivotal not only for silver, but also for gold in the broader fiat currency system. And we saw that on a major scale as recently as 2023 when the Federal Reserve instituted its Bank Term Funding Program, the BTFP. Some of you may remember that, to save banks that had massive unrealized losses as a result of falling bond prices in the fallout of interest rate hikes in 2022 and 2023. And this is a policy, along with lingering unrealized losses in the U.S. bank sector, which you can see here on the screen right now, that persisted today. So bailouts, what I want to say about the bailouts is that they are something that we live with even today. That said, despite some well-publicized stories about trading desks at some large banks shorting or again betting against the price of silver, I demonstrated in 2 videos last year that the largest banks have started to go long or bet for the price of silver to go up, with some of the manipulations we saw around the 50 level, signaling that large players were smashing the price of silver down, not to keep it down, but to be able to get in at a better price leading into the major breakout in silver. Price with the November 2025 computer crash, caused by an alleged cooling issue at the Chicago Mercantile Exchange. Being the major moment, I have said banks flipped from being against silver to betting for silver in a situation that was an exact copy and paste of what we saw documented in the famous film The Big Short, for those of you who have seen it where banks use the excuse of a computer crash to hide the fact that they were dumping worthless mortgage bonds on clueless investors who were buying them up as the banks themselves started betting against the very bonds they were selling. And I bring this up to say that although bank bailouts remain a reality in 2026, it doesn't have anything to do with silver or gold prices for that matter. In a reality where big banks are actually betting on them to go up now, and in a reality where, as most of us know, there simply isn't enough of the metal, specifically silver, to go around. And this situation was perfectly summarized by Josh Farr, who is the founder and CEO of the Scottsdale Mint. In fact, he appeared on my channel last year, and I will be meeting him up in Berlin, Germany at the World Money Fair in 2 weeks. So, if you'd like to see me do a video with him again, please let me know in the comments section below. But he made this post on X 2 days ago, which has now racked up more than 700,000 views on the platform. And it details what has changed for precious metals, namely silver, since 2025. And I will link that clip up below for you all to see for yourselves what he said. But even though the entire market is seemingly lining up to participate in this young bull market for precious metals, it doesn't mean they're supportive of it. And it definitely doesn't mean they want you to participate in it or benefit from it. Because while banks are securing their positions in gold and silver right now, they are actively trying to discourage clients from doing it themselves using scare tactics like the Bloomberg rebalancing story to make you think a major price crash is coming, so you won't take your money out of the bank to buy something that is out of their control. And in some extreme cases, they are even blocking people from using the money they have deposited in the bank, using the excuse of scams in the precious metals market to prevent people from buying gold and silver, even from reputable dealers, as was covered in this clip, which I have permission to use, made by Taylor Kinney just 2 days ago on X. And here's what she had to say. They are blocking the exits into gold and silver, aka capital controls, or banking restrictions on how you can spend your money. Let me explain. I work for a full-service gold and silver physical gold and silver dealer. And today we had multiple clients who were trying to wire us funds to purchase gold and silver to escape the failing fiat system. And guess the banks are no longer allowing the wires to go through, not just to us, but to any precious metals companies. Now, the official reason they're giving is because they're worried about fraud, about scammers out there. And it's not to say that there aren't any in the space, but to have these banks put in a blanket policy, no precious metals, no gold or silver at all. They don't want you outside their system. They want to keep you in the fiat system. If you transfer your wealth into physical gold and silver, they're no longer making a fee off of you. They can't control you. They can't freeze or seize your assets. The illusion that they have built is crumbling because more and more people are waking up. Now, although these are just temporary solutions to a growing problem as more regular people look to at least partially exit the fiat currency system in favor of holding physical precious metals, I expect more extreme measures to come into play moving forward. And I'm not saying any of this to scare you or pressure you into buying gold and silver now, but you need to know this because the next tactic we will see being used against physical gold and silver stackers to keep them out of precious metals is to completely price them out of the market. And in a situation where at current spot price, the typical US household can only afford to save, and these are updated figures by the way, can only afford to save 37 ounces of silver in the course of a year, which is a 93% drop versus what the figure was at in 1990. It's not going to take much to completely exclude people from stacking physical precious metals, and the model I expect to see used at some point in the future is the one that is currently being used against silver stackers in Europe. And Americans really have to listen up to this part of the video because when you buy silver in Europe today, an additional value-added tax is tacked on to the purchase price, with an additional 20% or more typically being added to the price of silver bullion products when you buy them, which is why Europeans who are still buying physical silver today are paying more than 110 per ounce for silver bullion today. And this is an example from a Polish website selling 1 OZ silver kangaroos. And I use this example as I warn you that metals prices are still going higher. To say, if you have wanted to protect yourself, even with a small part of your savings in gold and silver, I'm not telling you to go Allen, but even with a small part of your savings in gold and silver, get in now. Because once the news stories and temporary bank blockages of gold and silver purchases stop working, this type of taxation system will come into play, and it will make your silver on the secondary sales market worth more than the spot price of the metal, even when you are selling it back to dealers as the market adjusts for the reality of taxation. And this is a situation, a reality, a market dynamic that is not in place in the United States yet. And this is the reality that people are experiencing in Europe, with dealers purchasing silver from people who want to sell it back to them at more than $6 above spot today. But to benefit from this, and to make sure you get ahead of what is likely coming at some point in the future, You have to act now because I expect it to become a lot harder to get into gold and silver the longer you wait. And the barrier to entry is not going to be a law against you owning it. As far as I can see, the barrier is going to be price and taxation, making it extremely unaffordable for most regular people to get in the first place. Now, of course, that doesn't mean that the market is going to become so unaffordable that nobody will be able to buy or sell gold and silver on the market. Of course, this only means that the amounts of gold and silver that you'll be able to buy and trade moving forward will go down as they rise in price relative to prices on the market, as fiat currencies continue to debase and people move their savings, specifically wealthy people who have a lot of money accumulated in the bond market, out of those bonds and into the precious metals market. So please don't think this is me trying to say that the entire precious metals market is going to become affordable and collapse. That's not what I'm saying. I'm simply saying that moving forward, it's going to be a lot more difficult to afford to get out of the fiat currency system. So what I'm saying is, get out while you still can. With that said, that's all I have to say for this video. I'm wishing you all a fantastic day and week ahead. Please remember to take care of yourselves and take care of each other if you enjoyed this content. Also, please take a moment to leave a like below, as that helps this content reach more people who may need to hear my message. And don't forget that if you have friends and family who would benefit from my message and from my content and my presentation style, to share this video with them, as it helps my channel grow. I will see you all in next week's video. Goodbye.